So I want to give a little bit more specifics about the fair value gap. That way you have the rules, what it looks like, so that way you understand exactly what it is and where it forms. Because this is going to repeat. Every single time, it's going to be the same logic that I'm going to show you here. Okay? Do not try to fancy dance this, okay, and try to turn it into some kind of a mentorship course and rename everything with your name. And don't do that, okay? Just take it for what it is. I already know people are going to try to take this and copy it and make courses out of it, okay? I've already given it to you for free. Because algorithms, the first element they operate under is time. So we're looking at, what does a bearish ICT fair value gap look like? Well, if you take a look at this diagram, it's rather crude, I know. But you have a run, preferably above some kind of an old high. So the first candle is the high. And the next candle is the extended low that goes below it. And the third candle is another continuation candle, but the main important factors are this. It's a 3-candle formation. The first candle's low has to be traded below on the immediate following candle. The next candle has to trade with an extended low as well that went below candle number 2, but does not trade with a high that trades back to candle number 1's low. What that creates is this small little gap where one candle only traded from the range of the candle number 1's low to candle number 3's high. So that little space that's occupied right there, what is actually occurring there is price is only being offered on the sell side there. So imagine if you're painting your wall at your home, okay? And you take your roller, you put it in the paint, and you put the paint up against the wall, and you roll down, okay? At first, the first foot or so, there's going to be an ample amount of paint delivered to the wall from your paint roller. But then as you keep rolling down towards the floor, what will happen? You'll start seeing these little pockets that look really porous, okay? What do you have to do to fix that? You just change directions and start rolling the paint roller back up, the same place you rolled down. That's exactly what price does. There's an algorithm that delivers efficient market delivery. You can argue with me all you want. You're not going to convince me. I know it. If you go into price action with that market efficiency paradigm perception of looking for this characteristic in price, I promise you, you will never look at charts the same way again. It'll unlock a lot of things. Remember the movie The Matrix? And Neo finally sees the Matrix as it really is in binary code, ones and zeros. He has clarity. Well, that same event, as silly as it may sound, ends up happening when you look at price action, when you start looking at it from this perspective. So let's go back into that analogy with this. Between this candle's low and this candle's high, we only have sell side offers. So that's like taking the paint and applying it to the wall and drawing down with the roller. But now as you pull down, there's little pockets right in here between this candle's low and this candle's high where price has not been efficiently offered for buyers. Why? How's that working? Well, you have sell side being offered here because the market's delivering lower prices. It's offering continuously lower prices between this candle's low and this candle's high. To efficiently balance out that little inefficient area, at some future time, the market's going to want to trade back into that area. When it does, and you're bearish, that's a short signal. Okay, you can go short and sell there with the expectation it's going to start to move lower. Optimal formations of the bearish ICT fair value gap will be found after a run into buy-side liquidity. So it's not a matter of going into charts and looking for this little gap all the time. This model I'm teaching you on this YouTube channel is meant for you to look for periods where price runs above an old high. Then it breaks down, and then you look for this pattern. This is what it looks like. You're not looking at anything prior to this candle. Has absolutely nothing to do with anything except for the fact that we traded above an old high. That's a very simple logic, isn't it? And the run above a single high or multiple highs, like a double top. Okay, either one of those fits this criteria. So what you're looking for is a pool of liquidity of buy stops. Resting above these highs, that's buy side liquidity. Smart money will want to trade up into that and go short. They may not be engaging above the high. They may miss it, just like any one of us that haven't been ready to take an order and place it in the marketplace. They may miss that. This is their saving grace right here, this pattern. That's what smart money is looking for. They're looking for that right there. And then once they see that, they go in either with their limit order, mark it in, something to that effect, and get short, and the stop would be above the high. Okay, there you go. Short and sweet, done. That is exactly what you're looking for a fair value gap.